Hey guys, what's up? It's Chad. Welcome to the new world, the new world order. President Trump has now been elected, and let's take a look at what happened over the last really about 12 hours. It's been insane. So in the bottom right-hand corner of your screen, you see this huge dip right there. So this is the this is the E-mini S&P futures. So you can see right here, huge dip right when Donald Trump started taking the lead, and it became apparent that he was going to win the election. Actually, I take that back. This dip was when the election was in question. And then when he started taking a commanding lead, then the market came back. And today, the market was up, actually. The market was up pretty substantially. Very interesting. So the E-mini got all the way down to 2028, which is pretty amazing. It was down 5%, and it got halted because they would not allow the futures to go down more than 5%. And it was halted for a while, and then the results started coming in a little firmer on the Donald Trump side, and we saw this increase. And, he gave his acceptance speech and everything, and people are talking about the increase in fiscal spending, in infrastructure spending that he mentioned, which would be a boon to the economy. And you've probably heard over the last several years, the Fed watchers have been saying that the Fed is out of bullets and we need more fiscal stimulus. We need more money from the government to come into the economy and support more jobs, buy more things, do more construction, and inject money into the economy that way, rather than just lowering interest rates and buying bonds and all that sort of stuff that the monetary policy does. So monetary policy is done by the Fed, and fiscal policy is done by Congress, right? Congress and the president, and they all work together to increase spending in difficult times. So President-elect Donald Trump wants to increase spending and therefore increase growth here in this country and, spur the economy into action. So what kind of implications does that have for all of our daily lives? So let's take a look. Here are bonds. You can see this big dip right there today. Bonds fell pretty heavily. And so the reason that happened is because people are thinking the Fed is going to raise rates. So if fiscal spending is successful, we hire a bunch of people, and the economy starts to run a little bit, what happens in that case is we get inflation. So if we get inflation, then the Fed will raise rates and bond prices will fall. And that's what you're seeing right here. So that's the projection that the bond market was putting based on President Trump's forecast or his talk for his plans for the future when he takes office. So that's why you're seeing that. But what does that mean exactly? So for us, if you are unaware, there's a lot of debt around the globe. So you may remember a year and a half ago or so, Greece defaulted on their debt. They have a ton of debt because they let everybody retire at age 50 with full retirement benefits. It's crazy. How do you fund that? You can't. Japan's another great example. So their debt is huge as well because they've been in a recession for a long time. They've been trying to spur their economy with monetary policy and with some fiscal policy, and now they owe over 2.5 times their entire economy. That's a mountain of debt. And if you look at the debt to GDP ratio for the United States, actually, it's really high. So our debt load is about 286 times the GDP of our country. that ratio is ridiculous because if you think about it, once debt becomes over the size of GDP, then it no longer stimulates the economy uh, to a beneficial amount. So once the debt is higher than GDP, that's like a debt to GDP ratio of 1, right? So basically, you take out debt to stimulate the economy, to create GDP, to create production. So the company grows and you're doing well. And then you pay off your debt and you're good. But once the debt becomes higher than your GDP, then you're taking on more debt, then you're creating an increase in productivity. Does that make sense? So if you're taking on more debt for each unit, if you have 1 unit of debt for 1 unit of GDP, then they cancel each other out. But if you have more than 1 unit of debt and less than 1 unit of GDP, then you're losing money, right? You're basically losing money in the long run. And the problem with debt is at some point you have to pay it back. Debt is basically borrowing from the future. You can't just borrow forever. At some point you have to pay it back. So the idea is that when the economy gets up and going, then you pay back that debt and you're golden. But if you are unable to pay back that debt, especially if you start having rates go up and inflation, then you fall way behind and then you get a fiscal crisis. So if you remember in 2008, the financial crisis was because we had so much debt and all of that debt was mortgages that were highly levered. So when those mortgages started to default, then we were a mess, right? We went into crisis. That's what happened. And the problem was all the banks were counting on those mortgages to perform because they're supposed to be safe. And when they stopped performing, then the bank investments that were based on the mortgages stopped failing. And it was a huge domino effect. So anyway, we are deleveraged from mortgages at this point. From 2008 to 2011 or 2012, we deleveraged our mortgages. However, we are way levered up on corporate debt, student loans, auto loans. Last year, auto loans topped $1 trillion for the first time ever. And we have a ton of auto loans, and a lot of them are subprime auto loans, which is how we got in trouble with home loans, right? The subprime mortgages are what caused a lot of the problems. So anyway, you can see that this could cause a very problematic situation. So we could increase growth with fiscal stimulus, but if that increases rates so far that all the payments that are due on all the debt that we have goes up, if we can't make our payments, then we're screwed. So everything matters. It's all intermingled. You can't just create growth by purchasing fiscal stimulus. You just can't do that forever without any implications. So very interesting. But for now, the market's up a little bit today. I actually think that this may be a little bit irrational. If you look at who's holding the S&P 500, it's in their interest for it to go up. So the institutions, the dealers, they were not short going into this election. They did not have a whole bunch of puts or a whole bunch of hedges on. So they're at risk. So to me, that's why you saw this movement in the stock market up after the election was finished. Once you saw that certainty come back into the market, the institutions, the dealers, they're taking advantage of that, and they're going to watch this market go up only to sell into the strength, and we'll probably get a pullback. Once consumers feel really comfortable, retail investors feel really comfortable, they think everything's going great, everything's bullish, then they'll pull out the rug from under them. and they'll start selling because they've made enough money. If they were short going into this election, then you probably would have seen this downturn continue, just because that's how it works. If the system is sort of rigged, it's not rigged in the way that Donald Trump always talks about necessarily, but the people that run the system are in it to make money, and that's how they do it. They sell when retail investors are buying, and they buy when retail investors are selling. So this pop could easily fade here fairly shortly. Maybe not tomorrow, maybe not the next day, but I really wouldn't be surprised. Okay. Anyway, so that's it for today. Just wanted to catch up on all those exciting developments in the political landscape. One thing I will mention is I have crude oil there on the bottom left-hand corner of your screen. So we are seeing a little bit of support here right around 45. So we may see that move up to the 50 level. And then right here is the dollar. You can see that huge move in the dollar. So we opened here, moved way down, and then finished up. So kind of mimicking the move in the S&P 500, but we finished up. So the dollar up usually means stock market down, but it's not a perfect correlation. But if it keeps going up, you could very well see the S&P 500 pull back. Just another reason to see the S&P 500 pull back. All right. Well, hopefully that was helpful, and I'll talk to you next time. By the way, I didn't see anyone talking about the debt story today, and that's huge when rates go up. So keep an eye out on that, and we'll talk more about it later. All right, guys. Hope all's well. I'll talk to you again. Bye-bye.